Ripple XRP holders, the unthinkable just happened. If you are following the XRP lawsuit, the SEC case takes a surprising turn following Ripple's decisive win in the lawsuit. All of that we're covering today in this video, on top of the entire crypto market cap in comparison to the stock market, in comparison to virtually every other currency out there right now, with this current strength of the US dollar in the DXY passing all-time highs back from 2016, going back to retest the previous highs of 2002. What is about to happen next in our economy is a little alarming, to say the least, with the US may needing a 7.5% unemployment to curb inflation. We're talking about inflation in this video. We're talking about unemployment rate as well too, on how the unemployment rate could potentially be too low. What is the downsides of low unemployment, and why is it beneficial for everybody out there to be a full-time crypto degenerate and quit their job to save this economy? We're going to discuss that in this video. So comment 777 if you're feeling blessed. Comment 777 if you're feeling bullish. You ready to become a millionaire? Let's run it. All right, my friend, welcome back to the channel. So right now there's 21,270 cryptos, $921 billion market cap with $51 billion in the past 24 hours. If we're looking at Bitcoin sitting at $19,000, Bitcoin had a pretty bad week, down 3%, about ready to crack into that $18,000 range. Ethereum at 1,276. XRP dropped below 50 cents, down 7% in the past 24 hours, but up 7% in the past week. So XRP is the only hope right now that a lot of people have in the cryptocurrency space in XLM. And if you watch the video that I talked about yesterday, I'm going to explain why in this video. I want to talk about what's happening right now, because when you look at the US inflation rate sitting at 8.3%, the chair of the Federal Reserve, Jerome Powell, said this is the new normal. Even Biden, in his recent interview, said
inflation rate month to month was just just an inch, hardly at all. But it was 8.2 or 8.2 before. All of a sudden, my God.
So at what point did we start measuring inflation in inches? I have no clue, but sitting at 8.3% right now, it is pretty alarming that it is still above the Fed's target of 2%. So we're going to talk about what it would take for it to get back down to 2%, because when we look at the effective federal funds rate, which everyone is discussing right now, drastically increasing, this is what's affecting 30-year fixed mortgage rates. This is what's causing people to bring money out of the stock market, out of the crypto market, and pour it into the US dollar. So when we're looking here, where could this potentially go? Because when I click on the max chart right here, you see back in 1980s, it was over 19, because with a high effective federal funds rate, to combat inflation, this may not be enough to save the economy. So we need to dig a little bit deeper, because the US may need a 7.5% unemployment rate to curb inflation. Because when we look right here, the US unemployment rate may need to double its current level at 7.5% to end this country's outbreak of high inflation, according to new estimates from a team of researchers, including 2 staff economists from the International Monetary Fund. Now, what that would entail is job losses of perhaps 6 million people, but research found that only under quite optimistic assumptions about the behavior of US job markets and inflation would the Federal Reserve be able to tame current price pressures with a smaller blow to unemployment. So this may not even save the markets. And they are saying that the median projected unemployment level would need to rise to 4.1% by the end of 2024 for inflation to drift back towards the central bank's 2% target. And either inflation will stay substantially higher, or we will have higher unemployment and a substantial economic slowdown. So when we look in the United States at the unemployment rate of 3.5%, total unemployed people at 5.8 million, and unemployed insurance claims at 1.4 million, Federal Chair Jerome Powell said this is the worst breakout of US inflation since 1980s, and the central bank is raising interest rates at the fastest pace since that era, when Paul Volcker used an intense crackdown on credit to break consumer price increases that at one point exceeded 14% annually, but success came at the cost of a recession as firms adjusted to slower economy and laid off workers, an unemployment rate that exceeded 10% at that time. So this leads me to the downside of low unemployment and why it makes sense to become a full-time cryptocurrency degenerate and smash the subscribe button on our channel. Because the unemployment rate is defined as the percentage of workers who are unemployed and actively looking for a job. Now, I know that might seem like common sense. Whoa, man, my chair is getting out of control. But common sense isn't so common anymore, because why would 3.5% be too low? Isn't that a good thing that people have jobs and that they're employed right now? Or is it really detrimental to the economy when most people who want them have jobs? So let's look right here. Let's talk about this, because the unemployment rate peaked at around 10% following the 2008-2009 financial crisis, and it began a slow but steady recovery that reached a low of 3.5% in February of 2020. Then in a matter of merely 3 weeks, 16.8 million Americans were forced to file for unemployment due to the shelter-at-home orders to avoid a viral infection that was harming a lot of people. Who knows what was going on there? Maybe you guys can fill me in the comments below. I'm not going to discuss that too much because of the controversy, but the key takeaways from this is low unemployment is usually regarded as a positive sign for the economy. However, a very, very, very low rate of unemployment can have a negative consequence, such as inflation and reduced productivity. So they want to balance it out where there's not too high of an unemployment rate, but not too low of an unemployment rate where everyone has jobs. They need at least a certain percentage of people getting their jobs took, like in South Park, because they took our jobs. When the labor market reaches a point where each additional job added does not create enough productivity to cover its costs, then an output gap or slack happens. And it looks like this on the chart, because this output gap, often called slack in the labor market in economics, it's calculated by the U6 minus U3, where U6 is total unemployment, hidden unemployment, and part-time workers seeking full-time work. And U3 is simply total unemployment. So you take this blue line right here, you subtract the yellow line, and that's how you get this slack percentage right here in green. And just as an economy rises and falls, so does the output gap. So when there is a negative output gap, the economy's resources, its labor market, are being underutilized. And conversely, when there is a positive output gap, the market is overusing resources and the economy is being inefficient. This occurs when the unemployment rate falls. And so when we look at the US output gap right now, it's currently in the positive. So the economy is becoming inefficient and overusing resources. Whereas back in Q2 of 2020, it was at negative 9.50. So the economy's resources were being underutilized because everyone was forced to stay home. So the level at which unemployment equals positive output, it's highly debated. And economists suggest that as the US unemployment rate gets below 5%, which it currently is right now, the economy is very close to or at full capacity. So at 3.5%, one could argue that the level of unemployment is too low and the US economy is becoming inefficient right now. And if we look at the real and nominal value of federal minimum wage in the United States from 1938 to 2022, this plays a role in as well, because this black line right here is the spending power of the minimum wage, and this blue line right here is essentially what the minimum wage actually is. And as you can see, from 1938, minimum wage has been increasing up until 2010, where it completely plateaued and flatlined at $7.25 an hour. Now, when I used to work at a hospital, scrubbing dishes and cleaning up throw up off patients' plates, I was making $7.25 an hour. And that was back in 2010. And I got a 15-cent raise every single year for staying there every year. And by the time I quit, just 4 years later, I was making $7.50 an hour. Because one thing I never realized was what was happening to the spending power of my dollar. So I decided to quit my job before I ever, wanted to fall into that category of people that were unemployed, looking for work. And it doesn't mean that I'm more smarter than anyone. I'm actually kind of an idiot. I'm learning new stuff with you every single day. But one thing that you need to know, and this is important for your future, especially if you have a job right now, on why you're not safe, is because look at this black line right here. How since 1970, the spending power of the dollar pretty much topped out and has been decreasing in comparison to inflation-adjusted wage and nominal US dollars. So if we look right here, this is where you can see the spending power of your dollar with the inflation calculator. If in 1938, you bought an item for $1, just $1, you walk down to the gas station, you grab a little pack of Twizzlers, grab some Big League Chew or some Wrigley's bubble gum, or say you're loading up on cigarettes because you need to get your fix and you haven't had a cigarette in 10 years, so you need you need about 10 packs. So in 1938, $1, $21. That's 2,000% cumulative rate of inflation. So what you could get in 1938, a dollar could buy you one of the most expensive items on the menu at Paul's Ship's Ahoy Seafood Restaurant in Los Angeles with steamed clams and drawn butter. So if in the next 100 years you think that you're going to be able to dip your clams, dip your crab, and dip your lobster in butter, you are gravely mistaken, my friend, because the spending power of your dollar is getting eaten alive. If we're looking at the US dollar index right now, temporarily the US dollar is on a rally. Now, for those of you that are wondering, what is the US dollar currency index, or the DXY? It is used to measure the value of the dollar against a basket of 6 foreign currencies. That's the euro, the Swiss franc, the Japanese yen, Canadian dollar, British pound, and the Swedish krona. Now, this index was established shortly after the Bretton Woods Agreement was dissolved in 1973 with a base of 100, and values since then are relative to this base. So when we're looking right here, we look at the euro. The euro is the lowest that it's been since 2002. We look at the Swiss franc. It's the lowest that it's been, since May, and before then was in 2019. If we look right here, the Japanese yen is getting absolutely destroyed right now. The lowest that it's been since 1998, over 23 years. If we're looking at the Canadian dollar, the lowest that it's been, where we're heading right now is all the way back to where we were in 2020. If we're looking at the British pound is the lowest that it's been since 1985. What is that, over 40 years, almost 40 years? It's insane. And the Swedish krona is the lowest that it's been on this chart since 2005, and arguably before there. So what's happening right now is causing a drastic liquidity exit right now in the stock market. And when we relate this all to, minimum wage, the reason why I talk about all this stuff, guys, is obviously so you can come to your own conclusion, but because unemployment right here is at 3.5%, being too low, the Fed thinks that hiking the effective federal funds rate is going to change inflation when it's simply not working. So we need to look at other stuff such as unemployment. So if you are relying on your job right now, well, if the unemployment rate is going to be going up to have any hopes of saving the economy, then you have to understand you are not safe working for somebody else the rest of your life. Because if you want to become a millionaire, how many people do you know that are working a full-time job that are millionaires? I don't know anyone. So you have to start a passive income side hustle while you work your full-time job, so you don't ever have to worry about potential layoffs. And also, if you are focused on the stock market, or if you're focused on the cryptocurrency market, well, the stock market and the crypto market are directly tied together because they're both manipulated by the elite. So when we see money come out of the stock market, money come out of the cryptocurrency market, and that money move into the DXY, into the US dollar, eventually something has to give. And it looks like that something that has to give is going to come out of the stock market and the crypto market first, because right now where we are on the S&P 500 is right at this moving average, which is the 200-week moving average. And if this 200-week moving average fails and the S&P 500 dips below it, we could be heading all the way back down to the 1,460-day moving average, or the 4-year moving average. And the last time we were at that level was all the way back in March of 2020. The last time before there was post subprime mortgage crash back in 2007 when we recovered above it. It took until 2010 to get to that point. And as you can see, during the last crash, when the S&P 500 broke below the 200-week moving average, it was a flash crash all the way down to the 4-year moving average, short-term recovery, and then massive crash below there, dropping another 40, nearly 50%. So this video is not designed to scare you. This video is designed to prepare you, because with billionaires calling this the worst crash since 2007, 2008, we're only down 26% right now. To drop another 40% will put us at about 2,800-ish on the S&P 500. Now, when we look at the crypto total market cap right now, we're riding right at the 200-week moving average as well too. And the last time that we were there was March of 2020 during COVID. The last time before then was the bottom for December of 2018. Now, a lot of people are arguing that this is going to cause a great reset, because something having to give with these currencies right now just being drastically down compared to the DXY and the US dollar, and the cryptocurrency market being down compared to the US dollar. People are saying that XRP is that phoenix that is going to spawn from the ashes. But we're going to discuss that because we need something that's measurable to fully understand what could take place as a most likely case scenario, a worst case scenario. And then for those of you that are playing into the best case scenario, you have to be prepared for the other to happen. Meaning, if we look back in 2018, we measure from the all-time high to the bottom, the entire crypto market cap dropped over 80%, almost 90%. So where we are right now, in comparison to the last bear market, we have dropped about 74%. So to drop another 80% or 88% would put us back down to retest the highs that were formed in June of 2019, and that would drop Bitcoin down to roughly $10,000 or $11,000. So right now, Bitcoin is forming a descending triangle where you can see the resistance right here. You see this flat support floor. And during a bear market, a descending triangle tends to lead to a downwards breakout, retest, and continuation of the downtrend before consolidating. So that's why I feel we still have further down to go for Bitcoin towards the end of this year, because the Federal Reserve has several more meetings to adjust the effective federal funds rate. And so far, they have been hawkish the past few meetings, every single meeting. So there's 2 more meetings before the end of this year where they're discussing raising the rate by about 75 basis points per meeting in November and in December. And if, or more likely when, they raise the effective federal funds rate to try and combat inflation, we won't see inflation go all the way back down to 2% anytime soon. Because the chair of the Federal Reserve, Jerome Powell, is saying that this is the new normal, he's psychologically preparing you for the markets to continue going down. Now, on the contrary, if we have seen the bottom for Bitcoin, and this is similar to what happened back in 2018, where we saw a bounce off of this moving average, a retest of it, and then 140-day bull market rally, then you definitely want to be prepared for that scenario as well too, by having passive income, so you don't have to worry about short-term market volatility and short-term dips, and you don't get too greedy to the downside, because I've seen a lot of people get too greedy to the downside and they're waiting for something like this to happen before they purchase Bitcoin around $10,000 to $15,000, when something like this may not actually happen and we may actually see a break out of here to the upside over the next few months. So what I'm personally doing is I'm dollar cost averaging on the way down, and also I am focused on creating passive income through Bull Runners Club that I'm going to share with you in a little bit, and our online business app. So meanwhile, while all this craziness is taking place in the economy right now, XRP's price is on the verge of confirming a bear trend correction from a rising wedge pattern. As observed on the 4-hour chart below, rising wedges come into play when an asset's price makes a big swing north that slows down to allow for consolidation. And it is worth measuring that the XRP price is trading marginally above the pattern support. Short sellers will, however, have to wait until the price closes or opens on a 4-hour basis below the rising trend line before activating their orders. Now, as you can see right here, this article was written when the price was at 51 cents, and sure enough, we saw a break to the downside to 49 cents. And where we're about to head next depends if XRP can hold this 200-week moving average in red. If XRP can hold this 200-week moving average in red and continue to push higher, then if we look at XRP on the 1-week chart right here, this is a massive area of resistance that we need to break through between roughly 50 cents and 60 cents. As you can see, back in January of 2022, we see July of 2021, June of 2021, it acted as a massive support zone. Now, if we can break through this, I believe XRP would snap relatively quickly to 70 cents to retest the 2-year moving average that you can see right here in yellow. And if we can hold that, then a retest of the high of April of 2021 would be more likely. However, if XRP does not hold this 200 moving average and we see a break to the downside over the next week, then XRP would more than likely come back down to roughly 37 cents before getting bought up really quick by the bulls. So right at these levels right here, we see a massive amount of sellers activating limit sell orders. So you just have to be prepared for that. So if you're planning on buying XRP, again, don't buy XRP, don't sell XRP because of any of our videos. I just encourage you to learn about this project. Yes, XRP is my #1 holding out of the large cap projects because of the lawsuit. So the SEC's case takes a surprising turn following Ripple's decisive win in the suit. And the main thing that they are waiting for right now is the SEC to turn in documents. While Judge Torres' agreement with Judge Netburn's ruling over attorney-client privilege protection of the documents has been welcomed by the theming XRP community, concerning remains as to whether the SEC will comply with the order. In a statement to Fox Business, counsel to Ripple pointed out that the SEC has flaunted the past 6 orders given by the court, compelling it to turn in the documents. This amounts to the SEC deliberately fostering uncertainty in the crypto industry. And Ripple has long considered the documents to be crucial evidence in the case, as they show how Hinman arrived at his personal opinion that Ethereum was not a security. And although the SEC can still appeal the last ruling, Johnny Deaton, a third-party attorney representing XRP investors in this case, had previously predicted that the case could settle within a 90-day timeline from when the SEC produces the documents. So, best case scenario, the SEC produces these documents, they go in favor of Ripple, they come to a settlement agreement, we see XRP break out, consolidate for a little bit, break out, consolidate for a little bit, and then ultimately break out, retest all-time high. Maybe we see a little consolidation period, a little slap back, but then ultimately we'll see XRP break to the upside to form new all-time highs, roughly around $8, $10, $15, maybe even up $30 before a massive correction comes in. So there's going to be a lot of profit taking along the way. And the reason why is because people that have been holding XRP for such a long period of time that bought within these ranges right here from, April when XRP was nearly $2 before XRP fell off a shelf in May, they're going to be taking profits through this range right here. So I would expect some insane volatility, consolidation period, but ultimately at the backs of a best case scenario with the settlement, Ripple winning the lawsuit, something happening there, that's obviously good scenario. Most likely case scenario is this case to get drawn out for an extended period of time, the next few months, maybe even a year, maybe even 2 years for the next bull run, and then ultimately form new highs in 2025.